Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is Michael Howell. Michael Howell, welcome to the show.
Thank you. Great to be on.
It's great to have you. So tell us a bit about yourself.
Well, how do I start? I mean, I run a company now called GL Indexes. That formerly was known as Cross Border Capital. We've been around for, more than 30 years. My previous life was working at Salomon Brothers, the US investment bank. And from that point, or when I was there, I developed the whole concept of looking at tracking liquidity flows and trying to understand the movements of money around the world, and using a concept called global liquidity as really the lever. And that is probably a pretty good summary of what we do. And I publish a Substack called Capital Wars, and I also that evolved from a book which was of the same name, Capital Wars, about 5 years ago.
When you were at Salomon, did your paths cross with Michael Lewis by any chance?
Well, briefly, in the sense that he was an intern when I was there back in the late 80s.
So he'd fetch you coffee then?
No. He was on a trading desk. It wasn't quite like that. But he was, he was obviously destined for bigger and different things. But he was certainly there. Yeah.
So, what was it about the liquidity flows that you realised weren't working, and you had to find a different method? Because we see the markets going up and down. We see people who can predict it using various techniques, maybe technical analysis, maybe economic theory. We know a lot of economics is nonsense, but there are some people that use it the correct way. Why did you feel that there was something missing, and what did you find?
Well, I think the first thing to ask is, when you say that economics works when it's done properly, I'd quite like to hear what doing it properly really means, because as far as I can see, modern economics doesn't work in any way, shape, or form when it comes to looking at financial markets.
I think Paul was just being polite.
Okay. I think maybe that's right. I think the fact is that it's clearly a missing element, or there is a major missing element in trying to understand how finance works. It's nothing really to do with modern economics. What moves markets is what moves markets in every sphere. It's the flow of money, trying to understand supply and demand and that backdrop. And unfortunately, modern economics doesn't give you any tools to do that. Certainly, it's a drift from what the markets are already saying. So what we do is track money flows, and the origin of that whole approach probably came from it certainly did come from when I was at Salomon Brothers, because Salomon Brothers basically had a philosophy, or maybe better to put it, an organization, which meant that the trading floor was really central to what the firm did. It was obviously a trading firm by definition, but if you have a big trading floor, you sort of, I suppose, establish the old adage of Salomon Brothers, which is, in financial markets, there's no unrelated event. And what you can see almost physically moving tangibly around these desks, are the movement of money. So you could see effectively when activity arose in, let's say, on the US Treasury desk, you could see whether there was a relationship to JGB, Japanese government bonds, UK gilts. You could see whether sterling forex markets were affected. You could see whether that started to shift into US equities or global equities. So you can see activity sort of visibly moving around the floor. And so, one area got excited. People were wondering why that happened. You've got news releases. You've got evidence of investors moving money. There was no unrelated event. And that was, I think, key to realizing that it was really all about understanding money flows and trying to track those money flows. And if you understand where that money is and where that money is moving, you've got a pretty good idea about how markets will ultimately shift. And that's pretty much the philosophy. It's as easy as that.
To what extent is are capital flows transparent, to the extent you can track them through a given organization these days? Because surely a lot of it's anonymized or dark or otherwise not so easy to track.
Well, I mean, the fact that something is difficult doesn't mean to say you shouldn't do it. And that's, one of the things that I think destroys a lot of modern economics is that basically economists look at put most importance on the data that is most easily obtained. For example, balance of payments data or trade data, relatively easy to pick up. And so economics sort of, puts huge weight on those numbers. Well, in actual fact, they probably don't mean very much. Where you've got to look behind what's really happening. And I think it's the same with money flows. If you look at money flows, they're clearly critical. They're difficult to get hold of, which is why not many people do it. I mean, we've been doing it, tracking these things for 30, 40 years. So we've got a pretty good idea where to look. And as you say, it's not transparent. In actual fact, a lot of it is transparent. A lot of that data is in the public domain. It's just a question of knowing where to look and actually getting that in a sort of time-friendly manner. We do that all now electronically. We used to do it originally by telephone call, a biro pen and or maybe a fax, and that was more difficult clearly to make a lot of phone calls. But now it's automated, thanks to technology. But the data's transparent; it's available. A lot of it is part of what is called the IMF reporting system, which every country, finance ministry, central bank is required to do for financial stability reasons, and we basically gather that data.
So circling back to the subject of economics, I mean, my comment on that was because there are people who are successful who use their own kind of version of economics. I'm a technical background, and actually, what you're talking about speaks very much to what I was doing when I was an analyst and a trader within the investment banks that I work for. Whereas many traders would just watch the market that they're focusing on, i.e. if you're a spot trader, you'd be looking at euro dollar or whatever that might be, whereas I was looking at everything from UK equities to the Brazilian stock market to gold to see what would actually affect and move those markets ahead of these other markets. And the only way to do it is to sit and watch them all day long. So I was watching it from a price perspective, just how the prices were moving, and it reminds me of I remember Bloomberg around the 2000s, it might have been, were talking about this new index called the money flow index. Now, I wonder whether that has got anything to do with your system. I never took it up or never used it, but I remember there was this big emphasis on where the money flow was, and it was equivalent to people who know technicals, some form of like an RSI oscillator or something that would tell you where the money was flowing. But it's never quite that simple.
Yeah, I mean, I think there's a lot of people who tried different techniques to try and, to establish or identify money flow. Salomon Brothers, way back long before I joined, actually had their own money flow analysis, which for the US market, which was basically devised by somebody called Laszlo Barini. And Laszlo looked at how volumes would affect different stocks. And so what he would look at is whether volume was going on an uptick or a downtick. And through various calculations, he could then ascertain whether money was net flowing into a stock or coming out of a stock.
Oh,
and that was actually that was a pretty useful exercise. You could only really do that for the US exchanges. It was very difficult to do for London or whatever. We did try for some time, but the volume data wasn't good enough to use. So that was really a US facet. So I think maybe the Bloomberg thing is a derivative of that particular approach. What we're doing is very different. We're looking at the origin of money, if you like. So we're looking at the creation of credit, going right deeply into what the central banks are doing and what the repo markets are doing, whether you get that liquidity creation, the flow of money through dealer banks. It's effectively a wholesale money measure. I mean, we're not really interested in aggregates like M1 or M2, which are much more retail money, and that's telling you more about what's happening in the real economy. So, for example, if you look right now at the US, you find that actually wholesale money measures some of these things like the repo market, for example, are slowing down quite noticeably, whereas the retail money measures, things like M1, M2, bank deposits, are really starting to accelerate quite noticeably. And that's telling us that activity is shifting from the financial markets to the real economy, which is, after all, what the administration is really wanting to happen anyway. They want a stronger economy, and they don't want such a sort of buoyant Wall Street, because it's just too awkward in terms of wealth distribution and whatever within the economy. So it's Main Street's turn, and Wall Street is starting to tread water. So the money flow is telling us that already.
Could that also mean that money's coming out of stocks and going into cash? Is that another way of reading those numbers?
Well, I think yeah. I mean, I think they're coming out of stocks and they're going into transactions in the real economy. I think that's a fair point. I mean, all money that is anywhere must be somewhere. So if it's in financial markets, it's not in the real economy, and if it's in the real economy, it's not in financial markets. You've got to think of these two things very separately. But the way that we do our analysis and process the data is basically to say that if you look at liquidity creation, it tends to move in a sequential fashion. And it's looking rather like you said with technical analysis at many different areas, clearly establishing the idea that there is no unrelated event. What you've got to look is for the footprint of that money flow through markets. So we basically tend to find that when liquidity expands, you tend to find the Forex markets moving very early. They may be giving you the first signal. So something like gold will be not a bad indicator. Then you will find it will move into the fixed income markets. So the indications to look at then will be look at how the yield curve is changing its slope. That's another factor, looking how term premium are moving within fixed income. Then you'd expect the corporate debt market to begin to move. High yield will be very responsive to more liquidity. Then you'll find equity markets start to get a bid, etc. Then it will move through different sectors. So, interest rate sensitive stocks will move first, things like tech very early on. Then it will migrate through different industry groups. You'll find commodity markets starting to get a bid sort of later in this cycle, around the time the real economy is just beginning to bottom out. And the whole paradox in this, which is very relevant right now, is that strong economies don't always have strong financial markets. So in actual fact, the paradox of this is that equity market gains are normally at their fullest or most strongest at a time when the world economy or the US economy is actually at a very low ebb. And that's the paradox that many people can never pick up. But that's simply because money, if it's in the real economy, is not in financial markets and vice versa. So if you've got a very slow real economy, financial markets are getting a lot of cash to use.
And as you said, it's like almost the best kept secret in finance, which is the presumption that economic growth equates to stock market performance, but as we know, they can be completely unrelated. And China's been a great performing economy, but a lousy stock market for the last 30 years.
Exactly, yeah. So a lot of they've directed a lot of that money into the real economy, as you rightly say.
Do you have a pecking order for, let's say, the purity or the clarity or the forward-looking aspect of the data that you study? Because I'm thinking, if you're watching money flow and basically giving a real-time commentary on where capital's going, that sounds akin to looking out the window, seeing what the weather's doing, but it's not the same as a weather forecast.
Well, it's absolutely true. But I mean, the fact is you don't really have to predict liquidity because liquidity itself is a leading indicator.
And because you referred already to a hierarchy of potential investment classes, so FX followed by debt, followed by maybe equity or whatever it might be. Do you have a preference for some of these as leading indicators as opposed to coincident ones?
Yeah, I mean, if you look at, the most sensitive asset classes by far are what you would call monetary inflation hedges, things like gold and Bitcoin, silver, etc. Those tend to be very early. So if you look at the lead times between liquidity, our measures of liquidity, and let's say Bitcoin, there's a pretty clear 3-month lead time. So if liquidity goes up, Bitcoin will move within 3 months. It starts to move a little bit earlier, but the peak movement is around up. It comes about 3 months later. Similarly with gold, maybe a tad earlier with gold, but it's that sort of period around 3 months. And then the yield curve tends to move around about, midpoint will be about 6 months afterwards, 6 months after the initial liquidity pickup. So you see so if you look at the markets right now, let's give an example. So let's take 3 asset classes. Let's take gold, Bitcoin, and bond markets with the yield curve. So what you've seen with Bitcoin is that Bitcoin clearly is taking a bath. It's in a clear bear market, and our view. Why is that happening? It's because mainly US liquidity, which tends to be the main driver of Bitcoin, is actually going down slowing down, I should say, not falling absolutely, but it's slowing down quite markedly. Now, why is that? Well, I mean, partly it's the fact that the Fed is sort of sitting on its hands or beginning to. I mean, it's sort of oohing and ahhing a bit, but generally sitting on its hands. It's not really creating a lot of liquidity growth right now. And against that background, you've had a very strong real economy. And our view is that looking at all the data, despite what economists say about impending recession, but they've been saying that for sort of 3-4 years now. If you look at the data, the liquidity data, it's showing a very, very strong pickup in US in the US economy. NGDP, nominal GDP growth, is on a tear. Looking at bank deposit growth, which is retail bank deposit growth. I mean, recently it's been annualizing at close to 10%. So that's telling you that there's a lot of spending power going through the US economy. And that isn't necessarily good from a financial liquidity standpoint, because money is clearly shifting from financial markets into the real economy. Hence, Bitcoin is sort of taking a bath here. And then you look at gold and you can say, well, actually, it's a similar phenomena, although gold tends to be driven to a much greater extent by China and the People's Bank. Now, if you look at what the People's Bank has been doing, rather mysteriously, after 3 years of very, very strong liquidity inflows in China, and my view is they have to do this to devalue the debt they've got. So they're trying to print money. But on March 2nd, they hit the brakes very hard. The PBOC basically curtailed all liquidity injections. They shrank their balance sheet, and they've been shrinking their balance sheet right up until the day after the MOU between America and Iran. And since that point, China has been expanding liquidity again reasonably aggressively. And so what is going on? And that seems that there is some tacit agreement between China and maybe the US that China has to slow the economy down to reduce oil imports. And they were doing that certainly through that whole period. And now they've changed. That, we think, was a major factor in weakening the gold market, because China had been Chinese retail has been such a major buyer. So we'll see what happens in the next few months and how much China injects back. But those are key factors to watch. And then you've got the yield curve, where you would say that if liquidity is going down, and clearly we've got evidence from the PBOC and the Fed that liquidity, or generally US markets, that liquidity is tightening. Therefore, you'd expect to see the yield curve flattening. The consensus trade at the beginning of this year from most economists, or all economists, I should say, was that the yield curves are going to steepen unambiguously through this year. They certainly haven't. They flattened dramatically. And that's telling you that liquidity is slowing. So it's very important to look at these related events and to try and spot the footprint of liquidity moving through markets.
The way that liquidity moves through markets in the way you described, the way it goes through the asset classes, how consistent is that? Does it always go in that order, or are there times when assets are swapped?
Yeah, I mean, very good question. I mean, the answer is no. Nothing is ever smooth. You've always got to be alert to something else. You might get a mania in a particular area where money is funneled in that area. You may find that an area which has been hugely out of fashion for maybe the opposite reasons, and that might get that might be an early winner from a liquidity injection. So you've got to be alert that it's not always the same this time. But generally speaking, that this is how it moves. So we've got to try and look for what we think is the normal script, and try and work accordingly. So in terms of our asset allocation, we're looking for the sequence, and we're looking for consistency in the sequence. Now, if you look at what's happened through this bull market, beginning in late 2022, and this has been an absolute plain vanilla bull market. Everything has gone like clockwork until the one thing that's been, we've got wrong this year is that we were not as upbeat on tech earlier on this year as we maybe should have been. And tech has come through very late, unusually. It's had a second wind. We got it right on the way up, sort of, in the first stages. We're very bullish on tech. And then we cooled off thinking that resources would be better. Commodities, and actually tech has kind of overtaken everything with a second wind. Now, whether that's a bubble or not, I mean, we've got to judge with hindsight, but it looks that way to us.
Yeah, I certainly have sympathy for that view, because I thought pretty much the same thing. The AI story was getting quite mature, and then everyone started to get really excited, which is usually a sign that you're near the top. But as we know, it's like bubbles can grow. I mean, I think it is potentially, well, it's got to be a bubble of some kind, because the numbers.
Yeah. Well, it's a bubble when it's a bull market that you're not invested in.
Exactly right. It's a very, very good definition. I must remember that. Yeah.
The thing with bubbles, as George Soros says, when I see the signs of a bubble, I start to buy, because there's usually quite a long way to go before it actually pops. And with regard to bubbles popping and perhaps a bear market that might be, soon, or it might be a few years away, how does the unwinding of this liquidity flow in your system, in the way that you track it? Does it reverse in exactly the same way that it comes together, or is there a different pattern?
Yeah, well, I mean, it reverses. I mean, it tends to, I mean, the old sort of saying in markets is that, markets go up the stairs and down the elevator.
Yeah.
So you tend to find that the progress up is slower, the way down is often faster. That's what we got to spot. Now, what tends to trigger financial crises is basically the inability to refinance debt. And where a lot of the current thinking is, we think, generally incorrect, is that if you pick up, for example, an economics or a finance textbook, they tell you that capital markets are there to raise money for new investment. They're not, clearly, because that doesn't happen really. In very few cases does that occur.
Certainly not in the UK at the moment.
Yeah, I mean, that's right. But I mean, even generally, I mean, okay, you might say, well, okay, this AI thing is maybe a small sort of step to the side on that, and I'll come quietly. But generally speaking, 80% of all transactions in financial markets today are debt rollovers. They're refinancings of existing debt positions. And what capital markets are just huge debt refinancing mechanisms. So basically, what does debt need to be refinanced? This is not saying anything about the new debt, of course. This is existing debt that's coming up for maturity and rolling over. What you need is balance sheet capacity in the financial sector, and that is that's how pretty much how we define liquidity. You can think about it, generically as the capacity of lenders. And if there's not that capacity in the system, then you're going to get debt default, or an inability to roll debt over, financial tensions, and a financial crisis. And who governs that liquidity ultimately are the central banks. And if the central banks are basically not injecting enough liquidity into the system, you will find there is a debt refinancing tension and a crisis. And if you look back over the last 10, 20, 30 years, I would venture that every financial crisis that we've seen has started out as a debt refinancing crisis. And central banks have been forced to come in and re-liquefy. So if you look to where we are today, and looking at the change in the structure of financial markets since the GFC, everything is now sort of focused on the repo collateral markets, particularly in the US. And so if you want to find evidence of tensions emerging, you've got to look very closely at the repo markets and the collateral markets. And in particular, the two things that we think are critical in that analysis are, number one, looking at SOFR spreads. And number two, looking at the stability of the bond market or the collateral markets, which is looking at something like the MOVE index. So rather than picking up VIX and trying to judge VIX, which is equity investors' sort of favorite risk indicator, junk that. Look at the MOVE index. That's a much, much better guide, because that's telling you how credit conditions are going to change. And if you've got leverage in the system, which we have, of course, that's the first test of whether leverage continues or whether it crashes. And that's what we monitor in particular as sort of guides to stability. And the Federal Reserve and the Treasury, as an aside, are looking pretty closely at these two things, because they're massaging them hard.
We in my business, we use systematic trend following funds, or CTAs as they'd be known in the States. And I continually cite the example of a meeting we had a little round table discussion probably 10 years ago now, that had some high frequency traders around the table. And one of these guys was asked, what's the longest duration you ever held a position for? And when that batting an eyelid, he said 3.5 seconds.
Yeah.
Are you seeing the trading cycle and the capital rotation cycle speeding up as a result of the hot money in the system now?
Yeah, I mean, there's no question about that. That's happening. But I mean, that's been with us for several years already. But I think that, it doesn't mean to say that some of these indicators I just cited are irrelevant or not valid. They're clearly very valid, because actually the system is resting more and more on this collateral base. If collateral values change, you're going to get huge disruption in markets. And that's why looking at volatility, which is maybe what you're saying, looking at volatility is so important. You need stability not necessarily in the end markets. So in the equity markets, you need them in the sort of the primary markets, the collateral markets, which is why bond volatility in the US Treasury market are really so critical here. And if you look at this evidence what the US Treasury is doing, they're engaging in a buyback program, which I'm sure you're familiar with. So the Treasury will go in and buy off-the-run treasuries, illiquid off-the-run treasuries, and replace those with shiny new, rather like swapping a second-hand car for a shiny new car. They're replacing those with shiny new bonds. The liquidity and the volatility of those new bonds is lower, and that helps to maintain the system. But the activity, the buyback activity of the Treasury is very, very much geared to prior volatility. So if volatility picks up in the bond markets, they're going to start doing a lot more buybacks. And that's what they do. So they're trying to keep a lid on this thing because they know how important it is. And then similarly, if you look at what's happening in the repo markets, the SOFR spread, which is the sort of replacement for LIBOR now, SOFR is being manipulated not in a malicious way, but it's been manipulated by the Fed, trying to keep sufficient liquidity in the system so SOFR spreads don't blow out against Fed funds or interest and overnight reserve balances. So the system is being very, very carefully massaged. And as I say to our clients, look, you're either reassured by that fact or you're more worried that cracks are appearing. And that's what we've got to be cognizant of. We've got to monitor the cracks, make sure it doesn't become an earthquake.
And I suppose one factor behind, in opposition to that speeding up process, is the rate at which large organizations change their mind on things. Before we started the pod, I saw a note from Ronnie Sturfley, who I imagine is someone you know, one of the team at Incrementum, the gold specialists in Liechtenstein. And he makes the point, I think UBS family offices have just released the latest research, and it suggests that given what's happening in the gold market at a sort of like a longer term macro level, their response to basically the depreciation of fiat currency has been to raise gold allocations from 2% to 3%, which is kind of meaningless in the greater scheme of things. So on the one hand, you have markets are doing what they're doing. On the other hand, you've got large organizations who are glacially slow at responding to these changes in trends.
Yeah, I mean, back in the 1970s, a lot of these Swiss family offices had 15% in gold minimum. So things have changed a lot.
So looking at your liquidity measures at the moment, are there any charts that you could show us, or is there anything that that they're telling you about the direction of the markets at the moment? Will the US equities, for example, potentially go higher from here, or is it, as most people think, a lot of people think, not everyone, that the markets are overvalued and heading for a bigger fall?
Well, I think the answer is yes, yes, and yes. I mean, let me just I'm going to put some slides up, and you can.
Brilliant. So, for people who are just listening, we will. Would it be possible to actually get a link to these so we could share that? Yeah. Fantastic, thank you.
I'll send them to you. Yeah. Okay. Well, let me just focus on 3 or 4 charts, and I'm gonna come back to them. Right. Okay. So the first one that we put up. And this is answering the question. I mean, basically, look, we think we're at the end of a cycle. I mean, the cycle clearly hasn't ended yet, but we're in that sort of grey zone where things are beginning to look a little bit more tense. Asset allocation isn't really binary, although many people treat it that way. You've got to think about it as an evolutionary process. And what this is basically saying is that the chart that you can see shows a black line, which is the underlying momentum of liquidity through world financial markets. That goes right back to the middle 1960s. And what that is illustrating is, as I said, the underlying growth rate of liquidity that you can see. It's shown as an index with an average of 50. That's the trend line. The red line, the red sine wave we put on top of that is a recurring cycle. That is a 65-month cycle. Why 65 months? Well, I'm not sure why. That's what the data tells us. My sort of justification for that is that if you look at what this is referencing, it's really looking at a debt refinancing cycle, liquidity providing that. Debt, that's an average maturity between 5 and 6 years, which is almost exactly 65 months. And so that probably justifies why this cycle is of this particular frequency. We estimated that sine wave back 25 years ago in the year 2000 using Fourier analysis. We haven't changed it since. We've just let it roll on. So what you see is what you get. You can see whether the accuracy is there or not, but it seems to largely match that 65-month cycle. The trough of the cycle peaked trough exactly where you'd expect in September of 2022. The peak has occurred as of Q4 last year, 2025. We're now in a downswing. We're probably just a tad below trend growth of liquidity. That is saying that things are getting more tense. As I stressed, liquidity is not necessarily falling yet, but it's clearly going down. And the trough is going to be sometime in 2027, maybe late 27, whatever. So we've got quite a long way to go on a normal count. The way that we interpret that is shown on the previous chart, which I've just put up, and that is looking at the notional asset allocation cycle. And what we argue is that there is a sequence. As I said, this is not set in stone. Clearly one has to interpret this, but this is the normal sequence of events. So you'd expect to see in the upswing of the liquidity cycle, as liquidity is fueling financial markets, the equities do best. They're key assets in the upswing. Commodities do very well around the peak of the liquidity cycle, which is really what's going on now. And then you start to get an inflection, which is identified initially by a bear flattening in yield curves, and then a change in leadership within the equity market, typically from things like cyclical value, resources, energy, much more towards defensive value type names, and then ultimately defensive growth stocks. So, we've yet to see that, but that's the downswing. And then at the trough of the cycle, bond markets, government bonds, just owning straight bullets, tend to be the best performing asset class. So owning a 10-year bond would be an ideal situation around that time. And then the cycle restarts again. So, we think we're at the beginning of this downswing. So we think we're in what we describe as a speculation zone, as you can see on that chart on the right. And that is the phase that we think characterizes markets. So returns can still be positive, but you've got very high volatility to cope with. And so the quality of your returns comes down relative to the previous calm phase. And then turbulence, as the name suggests, you want to be out. But we're approaching that. Now, some of the evidence for that, maybe I can evidence what is going on. And I've just gone too far. If you look at this chart, this is looking at US liquidity versus the yield curve. And the orange line is US liquidity advanced by 9 months. I've been using this analysis pretty much since I was at Salomon Brothers in the 1980s. And it works. It's worked, for me, pretty much every cycle. And what this is showing is, as the liquidity cycle expands, you want to start to move towards a steepening curve. As the liquidity cycle inflects lower, you want to be starting to shift towards a flattening curve. This is exactly what we've got going on right now. And if I show you on the next slide, this is my interpretation of what happens. And this is sort of, deeply theoretical, I suppose, but maybe a bit wonkish if you're not in bonds. But this is basically saying what you'd expect the yield curve to do. And the reason for showing that is that we've come out of a phase, which is the top right, which is the calm phase, which is when equity markets were, doing really well uninterrupted. You've had, during that phase, signs of economic recovery. Yield curves were steepening. They were seeing a bear steepening. So in actual fact, the long end of the market was selling off. Now we're in what we call a speculation zone. That's sort of because the economy has seen much stronger growth, particularly in the US. That's a bear flattening of the curve, which means that the long end goes up, yields rise, but the short end is rising faster because there is anticipations of the Fed or others actually hiking interest rates. But it's the next phase you've got to be wary of, and that's the phase that we call turbulence. And all I'm pointing out here is that so far we're moving in a sequence that seems to be pretty normal. And therefore, I'd be concerned or looking for signs that we may be flipping from one regime to the other. Don't think we're there yet, but clearly that's an important factor. And the other thing I wanted to show was, just to go back in the presentation, is to look at what's happening in the gold market, because I think that's probably instrumental of maybe many people's interest. This is looking at PBOC liquidity injections. People's Bank of China. This is the change on a year ago. We're showing this year-over-year change because there's huge seasonality in Chinese data, which is kind of difficult to extract easily. So a year-on-year change is not a bad way of trying to judge what they're doing. And this is showing the huge expansion on liquidity from early 2023 until March the 2nd of this year. And this, bear in mind, is the change on a year before. So up at about just over 6 trillion yuan is about $1 trillion US. So these are not small amounts. These are big amounts of cash going in. And you can see what they've done through this year. They've just hit the brake. And that's extraordinary. But it basically attests, so you can see it in more detail here on the second chart. It's basically because in my estimation, this is all connected with the Gulf crisis, and they wanted to cool the economy. Is there precedent for that? Yes. They did it in 2008 ahead of the Beijing Olympics. They hit the brakes then to cool the economy, so pollution was not something that could interfere with the showcase event. And then they restarted the economy again, and they seem to have done that again in March. Chinese data we know for the last few weeks have been pretty dire in terms of economic performance, but hopefully that will be picking up or stabilizing again. And the reason that's important is that if you look at the gold market, look how the gold market has broken. And this chart is maybe a few days out of date, but you get the idea. And this is looking at gold in yuan. Now, why on earth do I look at gold in yuan, not at US dollars? Because China is controlling the gold price. And what they're doing is they're monetizing their debt. So they're trying to devalue the yuan internally while maintaining the facade of, let's say, an externally strong yuan. I'm not in the camp that says the yuan has to revalue and it's undervalued. I just don't believe it is, because I think common sense will tell you that if they took their capital controls off, the yuan would collapse. A lot of Chinese would get their money out as fast as they could. And what they're doing is cementing those capital controls. They're adding to them in the sense that crypto has been banned in China. Investors can buy gold, but they can't export gold. And what they are doing is they've been buying gold. And you can see that this chart is moving up at almost 5,000 yuan steps until the break has occurred. Now, that break has been triggered by PBOC liquidity. And this chart is just showing you the correlation between the yuan gold price in orange and PBOC liquidity. This wasn't the great debasement trade that everyone figured. Okay, that's still yet to come. That's in the long term. It's definitely happening, a great debasement, but it's happening at a much slower pace than many commentators argued. But what is going on is that China has been trying to debase its currency more hurriedly, and that's really what's exercised the gold market in the short term. And you can see gold here in orange has moved almost exactly in line with PBOC liquidity, and it's come up and it's gone down as the PBOC has hit the brakes.
So, I mean, that incredible amount of data there. That's fantastic. So, what to ask a simple question about what we've just seen here? Where does that suggest that we need to wait for more liquidity to be pumped into the system by the Chinese to see the gold price up, or can it move up for different reasons?
Well, it could of course move up for different reasons, but I think the main driver of gold has been the Chinese. They're trying to do two things at once, which is always very difficult, maybe impossible. They're trying to devalue the yuan internally to get through their debt problems, and this is the only solution they can take. I mean, to be realistic, I mean, look at what Japan did, look at what the US did after the GFC, look at what the Scandinavians did in the 1990s. These are the only solutions one got to sort of huge debt overloads. You've got to devalue your currency. And the Chinese can do it internally because they've got these capital controls on. And that means creating domestic inflation, which means that, basically prices, wages, asset prices have to rise relative to that debt burden. And that is what they're trying to engineer. Now, they're doing that by printing money, or they have been doing that. I think that the recent, hitting the brakes has been for geopolitical reasons, but, hey, let's see. I'm not an oracle on this. I'm just trying to guess. And they're in charge of gold. On the other side, the PBOC is continuing to buy gold. The authorities are encouraging domestic investors to buy gold. So China's importing a huge amount. The PBOC is buying officially. They're telling us some of their purchases. I'm sure they're not telling us all of them. I'm sure Russia has been selling a lot of gold of late because of its sort of dire situation. And I'm sure the Chinese are accumulating it. But what they're trying to do at the same time as this is to give some stability to the external value of the yuan by basically effectively putting or building up a sort of quasi Bretton Woods arrangement around the Chinese currency. So they've got a gold exchange standard. They and some of their acolytes are basically holding gold rather than US dollars. I mean, they're clearly big dollar holders still. There's no question about that. But at the margin, gold is becoming more important to the Chinese system. So they're building a rival international currency to the US dollar. This one will be, I'm not going to say backed by gold, but will have gold as some sort of support level.
So that in itself would just suggest that the trajectory has to be to the upside, because clearly they haven't finished with that operation. They would want to buy more and continue to.
Yeah, I mean, look, the fact is that we've got the bottom line is that we've got way too much debt in the system, and debt has to be refinanced or it has to be devalued in some way. But ultimately, it's got to be refinanced. And China's debt burden is just enormous. Okay, I mean, Japan historically, the US after the GFC. I mean, it pales into insignificance relative to what China's doing, what China's accumulated. Masses of empty cities or whatever. They've got to devalue that debt. And the only thing they can't default it, because in modern financial systems you can't default for the simple reason that thinking about this repo collateral system, new lending is built on the foundations of good quality old debt. So if you kick away the old debt, devalue the debt, you're destroying the foundations of the financial system. You simply can't do that in the modern economy. So what you've got to do is basically devalue the debt, which is by printing money, creating domestic inflation, and that's what they're doing. So if you're creating this, and you've got huge potential buyers of gold in China, a billion or so of them, the gold market's got to go up. I mean, this is not a tomorrow event. This is a long term. Since year 2000, the amount of US debt, federal debt, has gone up, I think, about 10 times or close to 10 times. Gold has gone up 12 times. The S&P has gone up 6. So the S&P has actually lagged, although it's been a very good performer, it's lagged to the devaluation of money. And we've now got, US debt problems, the problems that the US has got, everyone's citing, are really future problems for the US, for Europe, for Britain and whatever, because there's so much potential debt to issue to basically fund these social welfare programs, pensions or whatever it may be. I mean, it's an eye-watering amount, but that's a future debt problem. So there is a great debasement coming, but it's coming at a much slower pace than people think. China's already got a historic debt problem it needs to get out of on top. So you add all these things together, there's got to be a massive debasement of paper money, of debts. And people say, well, okay, that's impossible. It's never going to happen. Well, okay, then what's the real value of a dollar or a pound sterling in today versus 1900? I mean, there's been massive devaluation. We're just kicking the can down the same road. And
given what you've said about inflation and debt and currency depreciation, why on earth would anybody who's got the choice, would they be owning nominal assets rather than real ones now?
I quite agree. I think you've got to restructure portfolios with that in mind. But this is a long-term view, and often cycles don't have any respect for trends, and so we've got to understand there are cycles out there as well. And if the Federal Reserve decides it's going to tighten, a lot of these monetary inflation hedges will clearly suffer. Now, my view is that's a great opportunity to buy more, but we've got to be realistic that things never move in straight lines in markets.
Sure.
The first chart that you showed us, could we just quickly go back to that, because I just wanted to ask a question about the amplitude of the 65-month cycle. So if we look at the 2013, 2015, 2017 highs there, we can see that the amplitude hit around 65 as opposed to the general peaks hitting 90. Does that tell you something as well about what's going on with liquidity?
Yes, because all this data is normalized, so it's basically what is people will understand as a Z score or a Z score. So it's a normalized data. So in actual fact, yes, it tells you a lot about the amplitude is important here. In other words, put it another way, 20 units is one standard deviation on that index.
Right. So, given that the amount of money in the system, for example, is at record highs, that's not necessarily shown up on the peak that we've seen in 2026 on your chart. That peak is lower, but I'm just trying to work out how that
This
works.
is the rate of growth. This is the rate of growth, not a level.
Oh, right. I see. That would make perfect sense then. Yeah. Okay. And are you managing money? How do you monetize all this amazing information that you've got?
Well, the answer is that we advise funds. We used to run. I mean, cross-border capital used to run money in the sense that it was a big fixed income manager. GL Index is more an index company, so what we're doing is providing data for institutions predominantly. We also write research, and then personally, I have a Substack called Capital Wars, which gives a synopsis of much of the stuff that's going on. So that's how it's monetized.
Great stuff. So, do you personally invest when you see things looking like all the stars are aligning and everything's going towards a really high probability trade, or do you basically
well,
just?
The answer is yes, but I'm not always right. But yes.
Well, who can be? And also, in terms of being all right, it's a question of timing, isn't it? Really, you might be wrong for a while and then right, and we can see how things have moved in say, for example, with Tim's fund and looking at the investments in the silver and gold miners that were unloved and undervalued for a very long time, paying great dividends, but nobody wanted them, and then all of a sudden, boom, they came into focus. So
they're quite unloved now again.
Well, yeah, it's we got a lot of excitement, didn't we, in terms of the market
quite quickly,
which is usually a sign that the short term investors have jumped in and a short term contrary signal. But it does look like the paths from different perspectives are still looking positive in that regard. But this is absolutely fascinating research. I know you've got a hard cut at 11 o'clock, so I don't want to overrun that at all. But for people before we sort of move to close, Tim, were there any final questions that you want to ask Michael?
I guess my question for Michael would simply be, what are your favorite trades right now?
Well, okay, I think the favorite, I mean, I suppose it depends on the time horizon. I think that if you look at, I mean, my view is there's a lot more inflation in the system than policymakers are fessing up to. I think the underlying momentum of economies is greater, particularly the US economy. And I think that, favorite trades are hard to say, but I would be, I'd still be pretty downbeat on the bond markets. In the sense that I think yields are probably going to have to rise. I think the underlying yield base of the US market should be nearer 6% than 4.5%. So I think that you've got, potentially bad news coming out of fixed income. That's not going to be a great environment for equities. I think if you buy US tips, I think that's not a bad longer term investment, having said all that, because at least you're going to get inflation protection. It's very difficult to get more than 2% in real terms from financial assets anyway, but you can get that, courtesy of the US government at the moment. So that's not a bad trade. I still like precious metals. I think they look good. I'm not going to say they're going to perform strongly near term, but I'd certainly be buying them on weakness, given what I've said. I think commodity markets look very undervalued against the backdrop of a strong economy. So I think those look good, but they've clearly had a very good run. So I'd be sort of positioned there. I mean, the question I've got is the extent to which the Federal Reserve is moving more hawkishly, and I think it's difficult to tell that at the moment. But the jury is out on Kevin Walsh, so I don't want to be too aggressive on risk assets until it's fairly clear. It's clearer what they're doing. Liquidity is telling you to be cautious. So I'm not going to stick my neck out there, but I think in terms of a long-term view, I'd be, happy with those, three asset classes. As I said, I'd be buying, gold, commodities, holding commodities, and I'd be thinking about tips as a long-term investment.
What do you think about Truflation's read of the economy, where I think it's showing inflation on a one handle, whereas the official figures are closer to 3 or much higher? I
can't believe that for a start. I think that, I mean, let me show you a chart that might be. Sorry, I've gone the wrong way. Let me show you this chart. This is a good example of maybe what's going on. This is looking at the tips market, which is the orange line. This is 5-year tips, break-even inflation in the US, which is saying about 2.5%. That hasn't really flickered higher or lower over the last few years, apart from the sort of the post-COVID spike. But if you look at the dotted line, that's a rolling 4-year average of the overall US GDP price deflator. So, there's a whopping great disconnect going on there. And my money is on the broken line, because I think that's clearly, definitionally telling us that there's a lot more inflation in the system than they're fessing up to. So I think that's true. I mean, anecdotally, I was in the US 10 days ago, and I tell you, first of all, the economy is booming, and secondly, there's a lot of inflation there, without any question.
Yeah, it's just so surprising that an independent index would be saying that. You'd expect it to be the other way round, but I'm
not sure why that's true, but it strikes me that, I mean, even anecdotally, a lot of Americans would agree there's inflation in the system.
Well, that's what you'd expect. That's what we feel here as well. So it does make more sense that way. Michael, thank you so much for coming on the show. For people that would like to find out more about you and your services, where do they find you?
I think 2 places. One is a website, which is glindexes.com, or the other is basically Substack, which is called Capital Wars.
Absolutely fantastic. Do you do the X at all, or have you got any handles?
Oh, yeah, no, there's a, sorry, I should have said, it's at Cross-Border Cap.
Fantastic stuff. Michael, thank you so much for coming on the show. Really interesting stuff. Thank you.
Good. Well, thank you.
Thank you. Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.